Miguel, how are you doing?
Hey,
You just had a missed call from me.
sorry for that. I was just wrapping up another call. Oh, yeah, I saw it.
No, it's more than fine. Actually, people always join like during the first 5 minutes or anything. So yeah, no problem at all. And thanks for your time, of course.
Awesome. Yeah, can you hear me properly?
Yep, I think I'm fine. If anyone can't, please say it on the chat or whatever. So great. How are things? New York?
No, I flew in from New York this morning, so
Really?
fresh out of red eye.
Jet lagged then?
Yeah, a little bit. Not too
I
bad.
guess how many times do you think you fly per year? Madrid, New York, or the other way around?
I don't know, 20 maybe a bit
Really?
more. Yeah. So 20
More,
return trips. Yeah.
more than once a month then, like near twice per month.
Yeah, maybe once every 3 weeks, something like that. Yeah.
Wow, not bad. So I guess that now you master
I
it.
hate it, man. I really hate it. I always get the cheapest flights, so I never get any miles or anything. So
Yeah, also Borja Aranguren from Kobe, he's doing like, I think he's doing something like 2 weeks in Madrid, 2 weeks in Mexico, I think. Yeah, they open there. And he says that for jet lag is the worst. Like the moment that he starts like picking up, he changes
yeah,
to the other way.
it's the worst.
Well, when I lived in New York, I came back for Christmas once for 2 weeks, and I went out every night such that I would keep the New York time, and it worked pretty well. But I guess that your schedule is a little busier than that.
Yeah, what I do is like not sleep for a night and then everything gets forced reset.
Yeah, makes sense. All right, I think we can get started already. I'm sure like some people will join in some minutes. Actually, on Tuesday we had another webinar also with a guest. We had Johannes Hatt, investor in JVH JVH, yes. And he used to be like the CEO of Product Soup. Like they got to 35 million ARR, they told us, or something, 300 employees, and now he's investing. And it was about the future, like what to expect in the coming months or like 2024 in the VC atmosphere in Europe, like the downturn and all these things. So I guess that will be interesting. Also, probably I will ask you your opinion as well, but also on something that, in my opinion, you are one of the best people to discuss, which is now that interest rates are higher and VC investment is lower, what are the alternatives for a startup, how to finance a startup, and how in general this trend has changed in the last years. So, well, first of all, again, thank you very much for your time. That I know you are busy and you have always said yes every time we have asked you for any minute. And well, I would like to start a bit on you and on Capchase, such that we understand better than also the rest of the topic. So, first of all, as in job interview, like live pre-Capchase, like from college onwards, why jobs you had, and like how you ended up in Capchase.
Yeah. So I studied mechanical engineering in Madrid, and then I did a master's in engineering in Munich. Then I worked in consulting for a couple of years, doing large projects for TMT, banking, and retail. And then I left consulting because I saw that I had always dreamt of being an entrepreneur and funding my own company. I thought it would be later in life. But in any case, when I was in consulting, I thought that I was solving problems for really large companies and very specific problems that were going to be like not really relatable to any company I had in the future. So I decided to try my luck starting a couple of companies at the same time that I was in consulting. And they were both like not very good ideas, so none of them worked out. And then I decided to join a company, an early stage company, to actually learn a little bit more about how to do it. So I learned, I joined the startup, a SaaS company. I was employee number 10 or 11, I think, and the first person in sales. And then I built and led the sales and customer success teams, and then the international team. And during that time, I learned a lot about new startups and VC-backed companies and ways to finance the business. And also, I experienced the friction at the point of sale, where when we were going to sell a deal, most customers wanted to pay monthly or quarterly or later, like maybe like in 6 months or whatever. and we as a company needed to get all the cash up front. And actually, like I would say that is one of the, like that is the essential way to finance the business, right? Get your customers to actually pay you, right? So then after 3 years in that company and taking it from 0 to a few million ARR, I went to business school. I was super lucky. I got into Harvard Business School, and there I started researching different ideas, mostly around that pain that we were suffering when we were in that company. And we came up with the idea of Capchase in around February 2020. And then when COVID hit, we actually had a lot of time to experiment, talk to people, and so on. And that's when everything kind of like got kickstarted. And we raised our first money in July 2020. And then since then, we've raised a Series A in February 2021 and a Series B in January 2022. And yeah, now, about 130 people across the US and Europe. So we have 4 offices in New York, London, Madrid, and Barcelona. We have a few products in the market. Our goal is to unify the revenue value chain of a SaaS company. So automate everything from proposal through, CPQ, through, negotiations, signing, invoicing, billing, collections, payments, revenue recognition, revenue reconciliation, and so on. And yeah, we have 3 products. One of them is several tens of millions of annual revenue. It's profitable, and the other 2 we are scaling now aggressively and in very steep, let's say, S curves.
Great, not bad. So then, what do you think that it helped? I mean, obviously, like in the part of business side and like knowing SaaS and knowing the problems of SaaS, definitely your experience in Joblink. But what about your experience as consultants? Do you think that it played a big role, or you think that if you had skipped it, then you would be in the same place?
I think it actually plays a really big role, because I think that even if the actual let's say job-related skills that you get, or let's say industry-related skills that you get are not that useful. Like, I mean, the stuff that I was working on for large TMT companies or banks or retail, honestly, I learned 0 out of that. But what you get is learning how to work, which is, I think, is super, super important, and learning how to use, Excel and PowerPoint, which sounds like super stupid, but it's super important. And also learn how to present a problem and how to articulate a solution and an approach to a problem. I think that is super, super, super important.
Yeah, absolutely. Like how to run a meeting, how to give news, how to ask for information. Yeah, absolutely agree on that. And then you said that you were that Capchase wasn't or at least your initial business line, Capchase, Capchase Grow, it wasn't the very first idea that you had, or it wasn't the very first. So how did it evolve? From there's a problem here until this is the solution.
Yeah. So when we were preparing for the MBA, you use the typical online courses, and there was an accounting course, and I remember going through 2 different companies. They were both making the same amount of money. They were both top line. They had exactly the same sales. They had exactly the same P&L statement, but they had very different cash flow cycles. So one had a cash flow conversion cycle of, let's say, 11 days, and the other one had a cash conversion cycle of 100 days. So what you actually saw is that the one with 11 days of cash conversion cycle, after a year, had a ton of cash and were generating cash like crazy. And the one with a cash conversion cycle of 100 days ran out of money on month 7, I think, right? So I started to think actually, cash conversion cycles is a really, really interesting thing that you can't see in a P&L. You can only see in the balance sheet and looking at both things at the same time. So I started to think about if there was a way in which we could solve cash conversion cycles by matching cash outflows and cash inflows instead of in one single company across a network of companies. So think of it like a splitwise for companies. So when we were investigating the idea, we were talking to a bunch of different companies, and everybody loved the idea, but nobody wanted to be the first one, because it's by definition a network idea, right? Once you have a network, it's super useful. If you don't have a network, nobody cares. So we're thinking about ways to get the network going with a different product. And then once we had all the data, we could just like turn on that feature and then start making a lot of money in interchange, money movements, effects, and a bunch of stuff. So then to get that data, we looked at two different options. One, offering analytics, or two, offering short-term credit. And the reality is that when we're discovering that, nobody wanted analytics and everybody wanted some kind of short-term credit or working capital to precisely solve for that cash conversion cycle. So, with that project, we started to look into different verticals, different products, and then we came up with Capchase.
Let me cut you here for two things. First, like this worldwide splitwise, to say, like I think the real extreme of that would be like to get rid of cash as a thing. I mean, not physical cash, but like in general, like at the end of the day, it's like any asset, including like an invoice itself, could be used as cash.
Yeah.
Right.
Yeah. Exactly.
Which is pretty ambitious.
Yeah. So it was like the typical, like idea that it's like really cool and you can model out and everything is perfect. And then in reality, it's almost impossible to execute.
I see. And the second question is, okay, then you see that companies say, I want short-term fund. But definitely, I mean, this question has been asked probably like in Babylon 4,000 years ago, like any short-term financing, and there are providers, obviously. So then it's like, what's the differentiation, or why like were you brave enough to say like, okay, this is not being done right, which is, in my opinion, the second oldest business ever, probably lending money.
Yeah. So, actually, there's a really cool book that's called 5,000 Years of Debt, which exactly talks about this and goes all the way back to like the Levant, like 5,000 years ago, and using that. Yeah. So when we started, what we saw is that one, SaaS companies are extremely predictable, especially once they've reached like predictable unit economics. You really know how much money you need to put in, and then how much money you're going to get out, and when. You have sufficient data to be able to predict that. And at the same time, most SaaS companies were just funding their growth with VC money. And let me explain like the actual problem. The actual problem is that SaaS companies have a lot of upfront costs. They have development costs, which are incurred upfront and are pretty expensive, with engineering talent and so on. And then you have customer acquisition costs that are also incurred upfront. And then, so that means that you're on the red, right? Like day zero, when you sign a customer, you're really on the red. You've spent a lot of money to acquire that customer and to develop the technology. And then you get paid over a month. You can be every month, it can be, every quarter, it can be every year. But it takes a while to get to let's say, above zero, above break even. So that cash gap, if you don't solve it, it kills the company, because the faster you grow, the bigger the hole gets. And also the steeper the hockey stick gets, right? Once all those cumulative cash flows start adding up. But what we saw is that cash gap was being funded mostly with VC money. And you think about VC money, it's super expensive. It is highly dilutive. And then it takes a ton of time to race around. And in boom times, it takes less, but in not boom times like now, it takes a lot, like months and months. So we saw that, hey, if it's predictable and we can predict it, so we get good at predicting actually, like when that cash gap is going to end, or when those cash flows are going to come in, maybe there would be cheaper ways to finance the growth of a SaaS business. So we said, okay, so if we can predict it and we know it's going to come in the future, then let's just discount it and give it now. And then when it comes in the future, we get it. So we started doing that. And we thought we were the first ones. And then we realized, and we found out that hedge funds have been doing this for a long time, primarily with utility companies. So for example, with like telco companies, with gas companies and so on, they will issue bonds that are backed by annuities from customers, annuities or monthly payments. And then the hedge funds buy those and they get paid, by bundling cohorts of customers that pay monthly. So it's like a similar concept, but for a different industry.
I see. So, well, it reminds me like to the securitization, like with the mortgages. It obviously can be right or wrong, or like any asset like with predictable cash flows. Okay, and then I guess that the traditional money lenders have completely missed this opportunity. Why do you think?
Yeah, so it's a couple of things. One is regulation, and the other one is economics, right? So on the regulation side, since 2008, the regulators in most developed countries make it really, really hard for banks to work with consumers or with companies that are not credit worthy, right? So in a consumer, there's like all these like credit bureaus and so on, but in companies, a very clear indicator of a company that is not credit worthy or is perceived as not credit worthy is a company that has negative EBITDA. So then in most banking models, which need to be approved by the regulator, if a company that has negative cash flows applies for credit, there is a binary outcome. If you're burning money, you get 0. If you're not burning money, then you get to the next step, and then they can underwrite the company in its entirety. So basically, banks find it really, really hard to work with companies and underwriting them based on the P&L. And then these SaaS companies have no assets, right? Everything is cash flows. So then a bank finds it doubly difficult to work with them, even if they have actual positive EBITDA. So then that is the regulation part of it. And then the economics part of it, a bank, based on their processes, which involve a lot of people, a lot of, document exchange and so on, it costs more or less the same amount of money to issue a $20 million loan than a $2 million loan, than a $200,000 loan. And the cost base is quite expensive if you think about all the labor involved into that. So then that means that loans that are below a certain amount are not profitable. So then you can only make those profitable if your cost base is lower. And the way to get your cost base lower is through automation, standardization, algorithms, machine learning, and all that stuff. So that's kind of like the paradigms that have enabled a business like us to thrive.
Respect to that. Again, every time I speak about Capchase, which is very often and always very highly, I always say that it's impressive how like an idea that they tell you in one line that is based on like one of the oldest businesses ever, it can be like so successful, and therefore like it was so much needed in the market, and you guys pulled it off incredibly. Getting a little more technical, what is the impact to a company like Capchase? I mean, then I would relate it to in general. To a company like Capchase of a VC downturn, like VCs pouring less money into venture capital, how does that affect you? Both in selling and then operating, I guess.
Yeah. Look, I think that VC down rounds are not that bad. Like, and especially, when coming out of a boom. The reason being is that as a shareholder of a company, if you have the ability to get more shares, because you're an employee or you're a founder and then you get like a top up, or you're an investor and you can buy more shares, what you really should care about beyond the price is actually the momentum of the company and the performance. The ideal scenario is a company that's doing really well in the fundamentals and whose stock price is very, very low, because then you can buy more or you can get more shares and so on, and then you will get the upside at some point once the market becomes rational again, right? So I think that down rounds, like for us, they don't affect at all. Like, in fact, like we are a great partner to VCs, whether it's an up round, a flat round, a down round, or whether there's no VCs involved. Like companies use Capchase to fund primarily growth activities as opposed to funding long-term activities like R&D, new products, new geographies, and so on, which are more better suited for VC money, right? So, with respect to down rounds, I think the thing that I'm seeing, in founders is the tough thing about down rounds is the communication to your employees and actually letting them know that this is just part of a journey and that it doesn't really matter as long as the fundamentals are right. So I would differentiate down rounds between companies that are just raising, a few $100,000 or a few $1 million, because otherwise they're going to run out of business. And it's kind of like a Hail Mary attempt to turn the business around. And companies that are doing well, the business is growing, the unit economics are getting better and so on, but the multiples are so depressed from 2 years ago that there is no alternative but a down round. So I would differentiate those two. And then the communication to employees, because people, we are rational and we like to look at our paper net worth, which means nothing. But if suddenly your paper net worth halves because of down round, that may create some questions. So I guess that my recommendation is to just make sure that you communicate it very, very clearly and that you're transparent, so that people's own individual narratives get replaced by the founder's narrative in the company.
I see. And do founders go more to you to Capchase now? Before, I would put probably date for like this economic downturn, I mean, or coming back from the boom in maybe like mid last year or beginning of last year, probably something like that. So,
oh yeah,
so I guess like startups are going like to you guys much more than before, right?
yeah, so much more. Like demand is through the roof, and people. I mean, again, like a down round is not the end of the times at all, right? But like if you can avoid it, let's do it, right? So there are a few ways to avoid it. One is grow slower, and then like just buy more time until multiples get back into, or like get a little bit higher than they are now, right? Because now they're historically depressed, right? So one is grow slower. Another one is to cut costs, and do layoffs, which so many companies have done as well, right? Just to preserve money and get more runway. Again, like another way of saving time. Another way is to get all your customers to pay up front. That makes a massive impact, not in the P&L, but in the cash flow statement, right? And gives you more cash to last longer as well. Another way would be to get non-dilutive capital. So convert, or like start, saving your funds for different uses of proceeds. Maybe, start using Capchase or some alternative for growth, which can consume a lot of cash and can scale indefinitely. Use your VC money only for paying engineers, product, and G&A, So there are a few ways to do it, to prolong or to avoid a down round. Another way is to just issue a convertible note or a SAFE, or a structured round that doesn't put a price in the company and that converts at the next round. And that's a little bit depending on your confidence as a founder, because it can bite you double if you actually don't execute properly, or it can actually turn out really well if you execute properly. I
see. And then what about your operations? I understand that Capchase, like its revenue, it's the commission you collect like when lending money, of course, but your cost is the failed loans. Have you seen like a higher amount of failed loans since VC money is more scarce?
No, it's been super stable. I'm going to explain why or how we did that. And like that's a really big part of how we became profitable in the main product, which is before, let's say like 2 years ago, our average exposure per company was much higher. And what we did over the last 15 months was, one, recognize that the environment was not the same, that companies were not growing as fast, and that VC money was way more scarce. There was way less equity money in the market, and it was much more expensive. So we started to just be more cautious about risk. The interesting part about Capchase is that when we give them a company money, if the company is growing, we always give a percentage of the ARR. So the company is growing, we get the risk with every incremental point of growth. If the company is growing slower, that the risk in position takes longer to happen, right? So it is just riskier. So basically what we did is rethink all the credit policies to make sure that we were not getting exposed too much, and then stress test every single decision or every single model so that our estimations of recovery rates would just be more robust. And what we've seen is that the loss rate has been extremely stable since November 2021 or something like that. And now the average exposure per customer is smaller. The advance rate, so what we give with respect to the AR, is smaller as well. But we can be partners for much longer for these companies.
Okay, so I guess that more sales, same profitability. Good news for Capchase, I assume.
Yeah. Awesome news. And also like there's no competition, right? Like a lot of the competitors pursued growth too aggressively with bad underwriting, and that's something that works when the market is working, when there's a boom market, but something that bites you back when things turn around, right? So a lot of them blew up and went broke or pivoted into other things.
I see. Makes total sense. So then regarding interest rates and VC investment, this is a little more technical, but that's why we have you here, because I guess you know about this stuff. Why is this relationship inverse? I mean, is it inverse or like why does one imply the other? What's the relationship between them?
Yeah. So let's see. I think that the short answer is that private investments end up following what happens in the public markets, right? So when the public markets are booming, after a while, the private markets multiples start to increase a lot. And when the public markets get worse, then the public markets get worse as well, a little bit later. So public markets getting worse, and the correlation with interest rates is because when companies are getting valued, mostly they're getting valued as the sum of all the positive cash flows that the company, or a sum of all the cash flows that a company is going to get over the future. So then growth companies, like if they're growing really fast, if you have a company that's growing at 20-30% year over year forever, that is a lot, right? Eventually, like that compounds and you get a ton of cash flows in the future. So if you're discounting to bring those cash flows to today, and your discount rate is zero or really, really, really small, then the values just add up, right? And then for you, $1 today doesn't matter, versus $1 in 10 years. When interest rates increase, then that $1 in 10 years gets very discounted, because suddenly maybe $1 in 10 years with a 5% interest rate, maybe it's like, I don't know, maybe like, I can do the math in my head, but maybe it's like 30 cents today, right? So then if you add up the same cash flows with a higher discount rate, it adds up to much less. That meant that the valuations in the public markets went down in some industries up to 80% because of that. So then it meant that it was much more expensive to get financed, both in the public markets. And then what investors did, especially, crossover funds, so funds that invest in private markets and public markets at the same time, what they had to do is they had to make a choice. And the choice was between investing in the public markets at maybe 6 times multiples of revenue in companies that were growing 40%, that were break even or even EBITDA generating and so on, the alternative, or investing in the private markets at 100 times multiples of revenue in companies that are burning a ton of money. So then when you have that choice, it is really clear, right? Like, why would you ever choose private markets? So then if crossover funds suddenly they start only investing in public markets, there's less capital in private markets. And then if a private investor that's investing in an earlier phase than a crossover fund, maybe it's Series B or Series C, they have to underwrite based on an exit value of the company. And if that exit value, again, it's a public market or an acquisition, suddenly the public market has a lot of influence. So then that price goes down as well, and eventually trickles down all the way to the seed stage. What we've seen is that, if you look at the public markets and the SaaS companies, you saw a huge peak during COVID, then a huge drop, and now they're like recovering a lot. And that is a consequence of mostly growth and profitability, more so than interest rates, which means that when interest rates go down, those stocks should probably go way higher.
And then, in terms for you guys, or like, well, for anyone looking for funding though, any alternative funding is going to be more expensive than it is.
Yeah.
So,
sorry.
Yeah, no, I mean, it's just like, I was thinking that it sounds counterintuitive, like VC money is now less available, but now like any other alternative is more expensive. So it's like, shit, it's like out of the worst of both worlds. Yeah,
it's true, and that's I think it's intended to slow down the economy, right? Like central banks to cut inflation, they increase interest rates, because if you increase interest rates, then unless a company's return on investment is higher than the interest rate, they won't take any money to lend, right? Or they won't do that activity. So then it slows down the economy, there is more layoffs, and then there's less pressure on the salaries, and then there's less consumption, and then there's less inflation, right? That's what they're trying to do. So when the interest rates increase, the cost of everything increases. Equity gets more expensive, but debt also gets more expensive, primarily because most of the money comes from the central banks lending money to the banks, and then the money being put in circulation. So yeah, like I think that's, like there's just no other way around it. It's going to be more expensive. Also, another thing that adds to the price is availability of funds, and fear and volatility, right? So if the price is going up or down, like you don't know how to price things, so then you're going to price it really high, so that if the price continues to change, then you're covered. So this year, a lot of those things happen at the same time. So interest rates are super high. They went up very quickly. And then there were a few very famous bank failures. So in the US, we had like 4 or 5 regional banks fail. In Europe, we had Credit Suisse get like distressed, acquired by UBS. So like all of that creates a lot of fear, a lot of uncertainty. So it increases prices as well. And then the volatility in the public markets with things like the war and so on, again, increases prices. So my reaction to that is you really need to understand the return on your activities. In startups, usually in SaaS companies with high gross margins and predictable unit economics, the return on a dollar of investment is pretty high. But instead of getting over levered and just paying a ton for money you're not using, you should think about what is the right amount that you should take at any given time and take smaller amounts, because even if they are more expensive per unit, you're actually paying less money. For example, if you're taking $1 million today for 3 years and you're paying 15% per year, you're going to end up paying, let's say, to make it simple, 45% of the $1 million in interest, right? Over 3 years. If you take 100K, every month, but you're only paying it for, let's say, 12 months, and you're paying 9%, or you're paying, let's say 20%, you're actually only paying way less because the average duration is shorter, right? You're using the money in a much more targeted and deliberate way. So there are ways to actually lower your overall cost, even if your interest rate is higher than before.
So all this, if I understood correctly, is triggered by the interest rates being higher, and then like it cascades in all these other consequences. So why would a central bank raise the interest rates? What is their objective if it would end up slowing down the economy, pressure on salaries, all that stuff?
I think it's to avoid the hyperinflation, right, or an inflation spiral. If let's say for example, there's a supply chain shock, right? Or there's a lot of money in the market and everybody has a lot of money and everybody wants the same thing and the supply is finite, then if you own the supply, you're going to increase prices because people want more of it than you have. And then if you're doing that, you're increasing prices, then if the job market is very hot, like there's very little unemployment, companies, if they want to attract talent, and this talent, what they're seeing an increased price pressure, they want higher salaries. So then if companies are selling a lot and they are making a lot of profit because the prices are high, they can offer higher salaries. And then higher salaries mean more money again in the market to spend. And then that creates a spiral, right? So inflation is really bad. And like it actually affects a ton of things. It affects the cash conversion cycle dramatically, affects a ton of things. So it's just terrible for the economy. So then banks want to keep it under control. And the way they do it is by increasing interest rates so that, again, as I mentioned earlier, things that are not good enough are not done. And that means that some companies fail, there's more unemployment, and then that brings costs down and you can kind of like start the cycle again.
Okay. I guess being the guy with the fine-tuning there must be a pretty tough job. A bit of a detour, by the way. This is more like a personal question that just came up to me. I'm sure you know a lot about it. By the way, anyone can ask any question, either in the chat or raise hand or even like unmute your microphone or whatever. But in the meantime, if anyone is like writing anyone, what happened to Silicon Valley Bank and in general? And what was how did you guys see it? Like in both for Capchase yourself or for your customers? I guess it was a pretty rough weekend, that one.
Yeah, it was a rough weekend. So what happened basically it was a little bit different than what we've been discussing, but it was caused by the increase in interest rates. And basically it was a mismatch of duration of assets and duration of liabilities. Basically, a bank, all the customer deposits are liabilities. They owe that money back to the depositors, and then they invest all that money that they have in different things to make money. So then what this bank did and all the other regional banks did is they invested a lot of that money in securities, in real estate securities, at very low interest rates that had a long maturity cycle. So then what happens is that in bonds and in securities and so on, if you invest at a very low interest rate, and then you're getting guaranteed, let's say 2% per year for the next 20 years, and then interest rates increase, and now you can buy a similar security in the market that gives you 5% per year, then your other security that was paying less is worth much less, right? So then what happened is that the assets were actually worth way less than they were before. And the liabilities, were actually like disappearing. So they thought they had to give money. They had to, let's say, like sell assets to cover those liabilities, because most of the customers were startups that burned money. They were not raising funds. So they were basically consuming the cash deposits. So then SVB needed to sell assets to cover liabilities, and those assets were worth way less than they were before. So then they went bankrupt. That erased the value of the equity, and then they went bankrupt. And what we saw over that weekend basically is that a lot of companies had the money trapped at SVB, and they needed to make payroll the following week. So they really had to scramble for money. And we worked the whole weekend to raise $500 million from hedge funds to be able to give like 30-day advances to these companies to be able to make payroll, to make at least 2 cycles of payroll until the Fed intervened the bank and released the deposits and the money market accounts. Yeah, I mean, like, these things are really, really technical. I'm not sure, like, if you want to go like down this rabbit hole, or there are the more like tactical things for founders that people are interested in.
No, to be honest, of course, like, it's great always to relate it, but in my opinion, it's it's valuable. Like, you are like obviously like in front line of all these things. In my opinion, of course, anyone that can ask to either like repeat whatever or like any clarification or any other detour. By the way, I just thought of the Silicon Valley Bank when you mentioned the banks failing and stuff. So how much money did you say that you needed over the weekend?
So we had companies with $7 billion in deposits that were trapped come to us over the weekend, and some of them like really famous names that everybody here would probably use or at least recognize, and they had in total, I think it was like $483 million in 2 payrolls, right? So over the next 30 days, then if the money was not released, they needed to come up with that money. So we raised $500 million. It was super expensive, and the terms were really bad for founders. So what we said is, like, let's wait until Sunday night to see if something would happen. And if nothing happened, then we're ready to wire on Monday. And then I think it was like 6 p.m. Eastern. The Fed stepped in and said that they were basically rescuing the bank and then selling it. So it was not necessary in the end, but it was a crazy weekend. I remember like walking, I don't know, like I think I was in the office from like 6 a.m. to like 2 a.m. Friday, Saturday, and Sunday. And then Saturday walking to the office, and there were like some people, some early risers, like, walking the dogs and so on, walking as if nothing was happening, right? And I was feeling like in that movie, The Big Short, when I was walking, I was like, these people have no idea that the financial world can like go to shit so much if this doesn't get solved by tomorrow. And it was a little bit weird.
By the way, I watched The Big Short a couple of weeks ago, actually. It's a super good movie, I think. Yeah, I think it's fun in the end how half of this thing is like very technical, interest rates, Federal Reserve, all that stuff. Half of it is completely human. Like, if people had started like panicking in other banks too, then it's the end of the world. And that part is more like the language is fear, insecurity, and stuff, not fucking interest rate.
And it happened. I mean, it happened. So SVB was the first, but then First Republic and Signature Bank crashed. I think it was like 4 or 5 days later. And then 2 other banks, I think it's Comerica and Bancorp or something like that, or Western Pacific, they also were distressed, acquired by bigger banks, because everybody put their money into the 4 biggest banks that are too big to fail. Like, and that's literally a financial definition, right? Too big to fail. That would provide systemic risk to all the financial ecosystem of a country. and there were like Citi, JP Morgan, Wells Fargo, Bank of America. So yeah, it was a crazy time.
Not bad. So going back to the high interest rates, low venture capital money. Well, by the way, actually a pre-question. Are they really high? Like my parents always say that they used to pay like 16% on their mortgage or stuff like that. I guess like we are not used to see, I mean, interest rates above 1, I think like many years ago. Are they truly high? You think it could go like much higher? You think those times are gone? Any guess?
I don't know, man. Like it is for me, and probably for other people in the call, it feels very high because we've all been, raised in, or I mean, as far as I remember, in the European Union, right, where interest rates have been kept like pretty low. The reality is that even with this, like high interest rates, that people adapt and companies adapt. And what we've seen is a massive shift to profitability and actually like better companies. So what high interest rates does is, again, everybody that doesn't make the return above the interest rate dies, right? Or finds it much harder to thrive, which means that it's like the survival of the fittest. So I guess that I think interest rates are quite bad because if you follow this logic, then only the biggest companies and the most, let's say, like stable companies will survive high interest rates. The higher the rates go, at least, and then that means that there's more concentration, less innovation, and so on. But I don't know what is really high. The reality is that a lot of companies have adapted, have turned profitable, have their unit economics, have way less waste, are doing more with less. And I think it's just like it creates better companies, but I don't know, man. Like if companies that were depending on lower interest rates suddenly have to face like higher interest debt servicing or things like that, it can get tricky to adjust as quickly as the interest rates did.
I think. Taking that into account, what sectors then do you think will be, what industries more hit by sustained high interest rates or sustained lower VC money, and what sectors would do better?
I think that a lot of sectors that, there's this thing that people call ZIRP, so zero interest rate phenomenon. And that's things like delivery in 12 minutes, right? Like all those sectors are kind of like a thing of a time of luxury, where money is free. So those have already been hit. Like there's been a huge consolidation, a bunch of them have shut down, and a bunch of the others are like worth is almost zero, right? So
you mean that need like that are very low margin, so like they need
like really low or even negative gross margins, extremely high capex, and then just a lot of people and like really hard to execute operationally. So yeah, like you could buy revenue, but that revenue did not provide any enterprise value in an environment with high interest rates. So I think that like those, beyond those, which are like super obvious and like we don't have to spend time on them, I think that what high interest rates does is it breeds also much more discipline on the spend side, right? So when I'm thinking of like, hey, if you're a company and you need to reduce costs, what costs are you going to reduce first? And what are you not going to spend on? And then whoever is producing that, those are going to suffer, right? So for example, we've seen HR tech companies suffering more this year, right? Because nobody was hiring that much. Actually, there were layoffs, or people were not spending that much in benefits or in things to differentiate from other potential employers, right? So then those have suffered. Things like sales and marketing tech have suffered as well, because one of the easiest things to reduce cost on is marketing. Literally, you switch it off and then you're spending less money per month. So imagine like the tech that supports more marketing, right? Like those has suffered as well. And in general, we've seen companies that find it hard to prove an ROI suffer as well. So any tool that cannot prove an ROI is suffering, because every single buyer is being much more disciplined when looking at potential solutions, and they're only looking for solutions that will help them either make more money or spend less money. So unless you can prove that extremely easily and transparently with a model, a business case, using your customers' data or things like that, then it's going to be hard to get your customers to buy you. And if it's hard for your customers to buy your product, then you're not showing growth, and then you're not getting money from investors, from debt, from anybody.
I see. And who's thriving then? Who's
So companies that can reduce costs, So for example, I mean, it's kind of obvious, right? But AI companies are crushing it right now. They're growing a lot because in some cases you can actually replace processes that were run by people by processes being run by machines. And like GPUs and all that stuff is expensive, but it's way, way, way cheaper than a person. Let's say that a person takes, costs, I don't know, like €2 per minute, to execute a task. So then basically a task that would take them 30 minutes costs €60. If you have a machine that can do 10,000 of those tasks in 15 seconds, even if each second costs you a lot, like it still is way less, right? So those are crushing it. Companies that help to, again, generate more revenue. So things that reduce friction at the point of sale. For example, our product Capchase Pay, where we reduce friction at the point of sale, is crushing it right now because everybody's looking for a product like that. Things that save costs. So I'm sure you've seen like this, like SaaS buying companies or procurement companies and like procurement software companies and so on. Those are doing well because like they're helping you to save money on things that you need and that you would spend otherwise on. So those are doing really well.
I see. So we covered stage we were mentioning before, sectors. What about geographies? Do you see differences between Europe and US and in all your geographies in Capchase?
Yeah, we released a benchmark report, actually like a month ago, something like that covers this in really, really deep detail. So it's on our website, so if anybody's interested, and you can kind of like put your data and then you get benchmarked based on your geography and your industry, and then you know how good you're doing. But what we've seen is that the US has recovered quicker, from like an investment and growth point of view. But what we're seeing for a while is that European companies were spending less, we're being just much more efficient. I guess it's a product of necessity, when there's less dollars available or less money available in Europe, then you just need to get more efficient, do your thing. So they were faster. But now, the US companies have picked up and the operational leverage, which basically is like doing more with less, has been faster there now. And it's rebounding faster in the US. Again, like in the US, inflation is under control now, or so they say. Let's say like between 3 to 4%. And in Europe is still high. So that also affects.
What about alternatives? Like we saw VC going down. I mean, in my opinion, always available for great projects. I always think like if the company is really good in the worst market, they're gonna get some money. It's more that bad companies get money when there's a lot of money in the market, which is objectively not very good either. Then it's banks that don't really know how to finance startups, following what we were mentioning. Then you guys, like, haven't all like other competitors popped up this year, or like with this situation that
No,
you guys apparently should, are doing well. So similar models like revenue-based funding or something.
Yeah, actually no. Like it's really, really hard to do a business like this. It's just, like now in hindsight, it's much more complex than a software business, because besides everything that you have in a software business, you have additional complications with capital markets and with risk, and you have to balance growth with risk, right? So it's a complex business in good times, and it's like hell complex in bad times, right? So if you need to raise or to start a business like this now, when interest rates are higher and capital markets are more skittish, it is impossible. It's just really, really hard. So we have seen zero new competition. But with respect to alternatives, you mentioned banks, you mentioned VC, venture debt is an alternative. To me, venture debt and venture capital is very similar. Both are like pretty long-term in nature. Let's say 4 years in venture debt, VCs more, even longer, right? And both are limited. So it's really rare to see venture debt increase in size as the company grows unless they raise another round. And then, like you mentioned, alternative investing, and alternative financing like Capchase. But I think the most important one is your customers, right? Like if you get your customers to pay you, then and to pay you upfront, ideally, that makes a massive difference, because that cascade that we're talking about, you would close it, right? So the thing is that if anybody that's listening that's tried to get the customers to pay upfront, customers never want to pay upfront, especially when interest rates are high, right? They're like, look, if I put my money in the bank, I'm going to make 5%. If I don't do anything, there's no chance I'm going to pay you upfront, right? And you think about it, like they shouldn't. If a customer is paying upfront, then the customer is financing the business, the SaaS business. If the SaaS business is offering flexible payments, the SaaS company is financing the buyer, right? That doesn't make sense either, right? So another alternative would be, getting a tool or like injecting at the point of sale of a SaaS company, a tool that allows SaaS companies to get paid upfront for a year or for a multi-year deal, but give flexibility to the customer so the customer can pay monthly. So the SaaS company gets the best of both worlds. They get a long-term commitment, they get the cash upfront, and the buyer gets the best of both worlds, which they get a great SaaS product and they can pay monthly, so they can keep the money. And that is actually like, that's the Capchase Pay product, which is growing really, really fast, and basically enables companies to finance themselves just with the customer's payments, which is it's probably the best option. And then the other thing, which is like, is not nobody talks about it. I'm not sure if you know Jason Lemkin. He's like the godfather of SaaS or whatever, but he talks about it. Is like, there is one thing that nobody talks about in SaaS, but it's actually extremely important, which is to get very, very, very good at collections. Like getting very good at getting your customers to pay you on time. And I don't have the statistics for Europe or for Spain, but in the US, something like 49% of invoices are paid late. So going back to the whole beginning of the conversation with the cash conversion cycle, if you're expecting to get paid, I don't know, in let's say 30 days, and you're getting paid in 60 days, that can really cause havoc in your cash flow, right? So getting very good at collections and automating collections is also a trick that is not going to cost you money because it's not debt, and it's probably going to increase your cash flow and your runway.
I can tell you that in Spain must be worse than that from clients, from my experience of us. So yeah, absolutely. And what about these revenue-based funding competitors, like could be Lighter Capital, Clearbank, Waveflyer, Rhythm, and Capt? What about these guys? What's your opinion? Crush them if you want.
No. So I think extremely highly of a bunch of those. The best ones are the ones that have focused on one single vertical. For example, Waveflyer only works with e-commerce companies, and they're crushing it. They're number one by far in e-commerce. Capchase, we just work with SaaS, and we only work with SaaS from the beginning, right? We are the number one in SaaS. Every other one that you mentioned, I've tried to do a little bit of everything, and that really sucks, and they've really failed because they, like, again, like if you have a model that needs to understand everything, then the model needs to be very generic. So when everything is going well, then the model is perfect and it holds, and you think you're a genius and you're making a ton of money, or you think you're making a ton of money, you're sending a lot of money out. But then when the economy turns and then you start getting defaults, you understand why, because your model is not nuanced. So then I think that financing companies should really, and like, if you're a borrower, then you should focus on companies that are vertical specific and that are really, really good at one vertical, because they're going to understand you more, they're going to scale more with you, and they're going to give you better terms than, generic ones. And out of the one that you mentioned, all the ones that are playing more than one industry failed and had to go through a pivot or a massive round of layoffs or multiple rounds of layoffs and then like reposition and work only in one industry.
I see. Great. So yeah, I guess then going back to the beginning, the key of your success is the underwriting model. So can you give us like the 1-minute version of like how you guys decide who to give money and how much?
Yeah, so it depends on a lot of variables, but basically we look at the revenue data, we look at the banking data and accounting data, and then automatically we come up with a percentage of the ARR that a company can access at any given time. For example, let's say it's like 20% of the ARR. For example, that means that a company with 1 million ARR today can access 200K. And if they grow 2x this year and they grow to 2 million ARR, then they can access 400K. And what the product does is, the goal is that the companies are paying the least amount of money, for the financing. So then the goal of the product is to prescribe also, like let's say those 200K, when you should draw it and how, maybe it's not 200K up front, or maybe it's like 30K this month, and the following month another 40K, and the third month another 50K, and so on. So you're drawing it on small increments that you can put to work immediately, as opposed to having a bunch of money in the bank that's costing you interest, but it's not generating returns.
So, well, now that we are almost in time, a recommendation to someone that says like, okay, I need to fundraise and VCs are giving me a cold shoulder. I think this is gonna go for a long time. So, like, what is the advice that is different now that it would have been 2 years ago with more VC money and lower interest rates?
Yeah, 2 years ago, you could just put up a data room, call a bunch of VCs and say, hey, we're raising. You have 48 hours to look at this data room, and then I'm getting offers. And like literally, like people would dance and do that. And then there was a lot of FOMO, and you can increase the price. And now if you do that, like people would just not even reply unless you're like OpenAI or something. So I would say you need to nurture the relationships. You need to understand, one, how to tell your story, and then start telling about your story to investors way before you ever need to raise. And then just, keep in touch. And like keep in touch can be a 15-minute call every quarter, or a coffee or a lunch or whatever,
Like
and then,
right?
Yeah, and you start sharing the amazing things, like if a founder can do something, is just sell the story, right? So start saying, hey, look, oh yeah, this quarter we grew 50% and we like signed these 3 amazing customers, and like just like share those things. And you find out about the industry, you may find out a little bit about your competitors and so on, and you're building a relationship. And then what happens is that sometimes investors will say that they're interested in learning more, which means that they may even start a process. And when that happens, then you can start telling others like, hey guys, we're fundraising in the end, like this is, as we told you 3 months ago, this is what we were going to do, this is how it's going, and like build momentum over months. But yeah, it takes a lot of time, man. Like to paraphrase Jason Lemkin again, it's almost like a CEO has to spend 50% of the time fundraising, 50% of the time recruiting, and 50% of the time on everything else, right? So it's just like, it's hard, but there's another way around this.
Okay. Makes sense. Yeah. No one started a business to rest, I guess. So yeah, perfect. So man, thank you very much again. Super cool. I did learn actually a lot. So it wasn't just for one. Like the questions were from me as well. And yeah, we are starting Academy, another edition of Academy actually by the end of this month on startup finance and also on venture capital. So on our website, like whoever's connected can find more information on those. We'll also post these webinars in YouTube for anyone that wants to watch it. And here we are, and hopefully getting like people like you for new webinars. So
awesome.
Thank you very much.
Thanks for having me. It was great to be here. See you. Bye.
See you, man.